Welcome. It's April 1st. This video is for April 1st. It's a Wednesday. And I looked ahead. The exam is Monday, April 13th. And that's also when submission 3 of your comprehensive financial plans are due. What you're going to do there is just add a retirement section. In other words, do a capital needs analysis for your family, making sure they're on track for retirement. And we could talk about that later as it gets closer. You would need to do a top-down wage replacement ratio, and then you would do a capital needs analysis. But remember, when you do stuff like the top-down wage replacement ratio, you know what their Social Security tax is, you know what their income is, and you know what their contribution to their plan is. So just be sure you're using the information from your family. Don't forget that. And so, in any event, here I'm going to do some of these slides, and then I'll set up a little homework for today that you could work out some problems on your own at home. So we use up the full 70 minutes. Again, I'm very confident we're going to finish the course. We're going to cover everything we set out to cover. And frankly, sometimes there's a snow day, and we don't get to everything. But I think this semester, using this format, we're definitely going to get everything covered. And so here we go. So now we're talking about distribution age rules. Distribution age rules. And so what does that mean? And so what we're talking about is, picture yourself. You're saving up money for years in your retirement plan. Perhaps it's called a 401k plan. That's the section of the tax code that pertains to retirement plans that are provided by employers, and they're tax advantage. So you're saving a bunch of money, and then now you're 67 years old and you have $3 million. Now you're going to take distributions. And so what this is about, this slide, is two very key distribution age rules that I think we've peeked at before, but we're going to take a look at them here. And so the first one is, if Corey takes distributions before 59 and a half, he'll pay a 10% penalty tax in addition to having to include the distribution as taxable income. So let's say in an example here, Corey's already, because he's working, in the 22% tax bracket. If he takes out a distribution of, let's say, $10,000 and he's not 59 and a half, he'll have to pay 22% tax. He'll have to declare it, and since he's already in the 22% bracket, he'll have to pay $2,200 tax on the $10,000 he takes out. But in addition to that, he'll have to pay another $1,000 in a penalty tax. So he'll have to pay like $3,200 because he took out money before he's 59 and a half. And when you're after you're 59 and a half, you still pay the tax on it. It's still treated as taxable income. But after 59 and a half, there's no penalty tax. So for example, if he takes out $50,000 at age 55, he'll pay a $5,000 penalty tax. That's 10% of the $50,000, in addition to declaring that $50,000 as if it were just regular salary. Remember, when you're saving up in a retirement plan, like a 401k plan, none of the money you put in was taxed, right? Like, it was all excluded income. The money you put in was excluded income, the money your employer put in. So the amounts that you put in year after year, never taxed. Not only that, the growth inside the plan, the dividends, the interest, the capital gains, never taxed. And so here, that's the first rule, the 59 and a half rule. I would have made it 60, but nobody asked me. The next one is, a person must start taking minimum distributions after age 70 and a half. So it's like they're telling us, well, don't take the money too early. And now they're saying that, well, if you reach 70 and a half, you better start pulling the money out. Now remember, the government's been nice throughout your entire career. They haven't taxed any of the money you put in or any of the growth. And now they'd like to get some tax money. So starting at age 70 and a half, you must start taking what's called minimum distributions. And we're going to discuss that. There's a whole table that we're going to look at. A required minimum distribution table exists. And we saw it a little bit on Retirement 1. A 50% penalty tax applies. That's a lot bigger than the 10% penalty tax for the 59 and a half age 59 and a half rule that we just saw on the other side of the slide. This is a 50% tax. So for example, if the RMD is 50,000 and the person doesn't take it, takes zero, his penalty tax or her penalty tax is half, which is 25,000. So it's a very steep penalty tax. When we're doing financial planning for clients, we want to be very cognizant of that. They're going to be very upset if they feel like we're the reason they didn't take their minimum distribution, if we didn't warn them. So we really want to do a lot of hand-holding with clients when it comes to RMD because the penalty tax is severe. So here's a question. We might ask ourselves, why does the government apply a penalty tax if you take out your own money before age 59 and a half? Why do they do that? Well, the government's acting like a parent. Remember, they gave us great tax rules. None of the money's taxed while you're working, right? The contributions aren't taxed that you put in, that your employer puts in. None of the gain year to year and the dividends, interest, and capital gains is taxed. Well, so now they get to act like our parent. They're going to say that you have to play by our rules. And they don't want us to take our money before 59 and a half because they don't want us to start spending money early. They want it to last through our retirement. Sort of like when a parent says you can't have your snack at this age because we want you to be able to have it later. And so, in other words, it does not want us to take out our money too early and spend it before we die. It doesn't want old people running out of money in their 70s. It wants it to last. And so the rule is if you take money out before 59 and a half, not only will you pay tax on it, you'll pay tax at any age that you pull money out of one of these plans, but you'll also pay, if you're under 59 and a half, a 10% penalty tax. Now we ask ourselves, why does the government require us to start taking distributions? First of all, they're saying on the left-hand side, don't take the money. And now, like what is that, like 11 years later, they want us to be sure to take the money out of our account. And the reason why is it wants to collect tax on our distributions. It wants us to pull money out so it could tax it. It's been very nice for our entire career. None of the money we put in or none of the gain year to year has been taxed. They want to get their money. And so remember, the tax has been delayed. We call it like deferred investing. We're saying that the tax is being deferred. It's tax deferred investing. So we don't pay tax on our contributions and employer contributions, nor are we taxed on the investment income year to year. So it's like, they're like, okay, enough already. You got to start taking out at least minimum distributions. We'll see the table for that in a bit. And take that money out and declare it and pay tax on it. So we call it tax deferred. We call it deferred taxation. The government is not going to allow us to defer it forever. You might think of somebody who has plenty of money, like from Social Security, maybe their spouse has money, and their idea is, well, I'm going to just let my money grow in my 401k and make my kids rich. Like take $2 million at 9% for 20 years. That's going to become into a massive amount of money that you could pass to your heirs. And that's really not the purpose of a 401k plan. The purpose of it is to save for retirement. And so let's go to the next one. Now that's the required minimum distribution table. It's an excerpt. In other words, there's a lot more years than the ones I show there. I'm showing 5 years. It goes all the way beyond age 100. And so what we do is we look at the divisor. And just so you know, if you divide that divisor into 1, like if I take 1 divided by 26.5 for the age 71 divisor, I get 0.0377%. So what that means is the first year that you're taking money out, following the RMD table, the first year you're pulling money out, you're taking out 3.77% of the balance of your fund at the beginning of the year that you're that age. And so if it's a year, unlike this one, where the markets are putting back 9%, you're taking out like 3.77%, and what's left in there grows at 9%. You'll actually see a lot of people in their early years, depending on markets, their retirement plan balances are growing. But look down the table. As you go down and you get older, you're taking a larger percentage out as you go along. So note, as you age, the percentage you must take out as a distribution rises. So let's see how this works. Let's, just to give us a good example here. Bill's 401k balance is $972,000, the last day of the year 2018. So essentially, the first day of the year 2019, it's $972,000. Okay? The guy's 73 years old. To figure out his 2019 RMD, just take 972,000, since he's 73 during the tax year, divided by 24.7, and that's his required minimum distribution, $39,352, nearly $40,000. If he forgets to take it, the government's going to assign a penalty tax to nearly $20,000, half of that amount, 50% penalty tax. If he takes out only $20,000, his penalty tax is $39,352 minus $20,000 times 1/2, or divided by 2, however you want to look at it. Pardon me. Okay, question. Refer to the previous slide. Assume Bill did not take any distribution. Well, let's multiply the amount. What was it? $39,352. Just divide it by 2 or multiply it by 0.5. So his tax would be $19,676. And having worked with clients before, Bill's gonna call me up and say, "Why didn't you tell me to take it? Because you should have known about the tax." And frankly, he's right. We need to be sure our clients are very well aware when they hit age 70 and a half that they have to start pulling out minimum distributions. And we want to really check off each year that our clients have taken it. So we're really helping them with this, because the penalty tax is quite high. The taxation on investment income, the general rule. Okay, what I'll do is I'm going to save this for video 2, because it's kind of hard to stream large videos. So video 2 will continue on with this.